The price is real, the signal is worse. Silver is holding above $51 an ounce. Gold is hovering near 4,162. On the surface, that looks like strength, stability, control. But here's the contradiction. Prices are calm while the system underneath is quietly breaking. And this matters to you, not traders on a screen, because when real assets reprice, it's your savings, your wages, and your purchasing power that absorb the shock. Major banks are now projecting gold at levels that would have sounded unthinkable just a few years ago, 5,000, even 5,300 an ounce. That's not panic, that's repositioning. What we know is simple. These institutions are adjusting upward again and again. What that suggests is more unsettling. They are preparing for something structural, not temporary. Now notice what isn't being said in those forecasts. No one is calling this a crisis. No one is using the word reset. Yet the physical market is already acting like trust is fading. And the first place that shows up isn't headlines. It's how price itself starts to fracture. What's happening right now didn't begin this year, and it didn't start with one headline. The current move in precious metals is being treated as a reaction, but it's better understood as a continuation. Fact, silver has stayed above $51 an ounce, and gold has remained around 4,162 until late November 2025. Those levels are being held, not spiked and rejected. That detail matters. It suggests acceptance, not speculation. At the same time, multiple large financial institutions are publicly projecting much higher future prices, not in one-off comments, but in revised forecasts that keep moving upward. This isn't isolated optimism, it's a pattern. And patterns force a harder question. Why are these projections coming now, and why do they cluster together? Here's the reframing most people miss. If this were just a short-term trade, the messaging would be cautious. Instead, the language implies durability, long-term positioning. So ask yourself this: if the system were healthy, would institutions be preparing clients for prices that imply deep currency stress? Or would they be warning about overheating? That question changes how you see everything that follows. Because once you frame this as a structural repricing, not a rally, the next pieces fall into place very fast. Here's the claim that makes people uncomfortable. This move is being driven by necessity, not enthusiasm. Look at silver first. Forecasts now point to it outperforming gold, not because it's safer, but because it's tighter. Its price is lower, its liquidity is thinner, and that combination magnifies every shift in sentiment. Targets near $53 by the end of 2025 and tests towards $60 in early 2026 aren't being framed as extreme anymore. They're being treated as plausible. That's the tell. At the same time, industrial demand isn't slowing down to make room for investors. It's accelerating. Solar energy alone is projected to consume nearly half of annual global silver production within a few years. Not half of supply growth. Half of everything mined. Pause on that. One industry pulling from a market that's already been in deficit for years. Now notice what's missing from the conversation. There's no realistic plan being discussed to rapidly expand supply. Mines don't scale on demand. Refining doesn't magically speed up. So if demand is structurally rising and supply can't respond, price becomes the only release valve. That's not theory, that's mechanics. And once markets start operating on mechanics instead of sentiment, reversals become much harder. This is where the situation stops being abstract and starts to feel unstable. A market can absorb high prices. What it struggles with is permanence. Silver has now been running structural deficits for years, not months, and instead of correcting, the imbalance is deepening. That's the escalation. Historically, when a resource becomes essential to national priorities, energy, technology, defense, it stops behaving like a normal commodity. It gets hoarded, it gets politicized, it gets quietly removed from the open market. We've seen versions of this before with oil, with rare earths, with semiconductors. At first prices rise, then supply chains stretch, then suddenly what used to be available becomes allocated. That transition is already visible. Refiners are under pressure, industrial buyers are locking in supply, investors are stepping in earlier, not later, and all of this is happening while prices are still being treated as reference points, not warning signs. Here's why that matters. When abnormal conditions become normal, markets stop reacting until they're forced to. And by the time that force arrives, price doesn't adjust smoothly. It gaps. This is where the story flips from appreciation to access. And once access is questioned, everything accelerates. The next layer is more disturbing because it exposes a contradiction people don't like to confront. Publicly, the system signals calm, prices are quoted, charts update, trades clear, but underneath, behavior is changing. Physical silver is no longer moving as freely as the paper market suggests. Dealers and refiners are abandoning traditional reference prices and switching to direct exchange data because the spread between them has blown out at times by as much as $2 an ounce. That's not noise, that's stress. It means the idea of a single reliable spot price is breaking down, and when price fragments, trust follows. Here's the contradiction. Screens imply liquidity, but physical flow says otherwise. If everything were fine, pricing benchmarks wouldn't need to be replaced. Now notice what this reveals. The market is quietly admitting that paper signals are lagging reality. Buyers who need metal now are paying one price. Observers watching charts are seeing another. That gap changes behavior fast. It rewards insiders and punishes late movers. And once participants realize that access matters more than quotes, they stop waiting for confirmation. This is the moment when a market stops being about value and starts being about priority. Pressure is now coming from multiple directions at once, and that's when systems start to wobble. First, refiners are overwhelmed. As prices surged past the mid-50s, waves of scrap silver flooded in from the public. Fact, major facilities are running 7 days a week and still falling weeks, even months behind. Second, that backlog is choking dealers. They can't move material back upstream fast enough to free capital or storage, so they stop buying. Third, liquidity fractures by form. Pure standardized silver still moves, alloyed silver, sterling 90% coinage suddenly doesn't. All of this is happening at speed. There's no pause to recalibrate, no orderly adjustment, just bottlenecks stacking on bottlenecks. And here's the destabilizing part. Demand hasn't disappeared. People still want metal. They just can't transact the way they expect. That mismatch, high demand, frozen pathways, creates confusion, frustration, and rushed decisions. Markets hate that combination. It's how orderly pricing turns chaotic. So ask the question most people avoid. What happens if this pressure doesn't ease? What happens if delays stretch longer and access tightens further, while demand stays elevated? Because once momentum meets constraint, control becomes optional. Now shift perspective, because this is where it stops being a market story and starts being a personal one. If you're holding older silver sterling jewelry, 90% coins, inherited pieces, you're discovering something unsettling. At the exact moment prices are the highest in years, liquidity can vanish. Dealers are turning people away, not because silver has no value, but because the system can't process it fast enough. That's not ideology, that's lived experience. You walk in expecting cash, you walk out holding metal. For others, the impact shows up differently. Premiums explode, waiting times stretch from days to weeks, products that used to be always available disappear from shelves. And this isn't happening in a crash. It's happening in what's being described as a strong market. That's the dissonance. You're told everything is functioning, yet basic transactions feel harder, slower, more conditional. If this feels familiar, if it reminds you of moments when systems quietly stopped working the way they were supposed to, say so in the comments. because those moments tend to show up before bigger shifts, not after. And once enough people feel it at the same time, behavior changes fast. This is where stepping back matters, because outrage doesn't explain what's happening, incentives do. The system rewards speed, leverage, and abstraction, not resilience. Paper markets are efficient because they don't require metal to move. Digital pricing works until someone asks for delivery. Physical markets, by contrast, are slow, constrained, and honest. They expose limits. What you're watching now is the friction between those two worlds. Institutions operate where flexibility is highest. Individuals operate where constraints are real. When stress rises, power flows toward whatever can delay, defer, or redefine obligations. That's why pricing benchmarks fragment. That's why access becomes selective. It's not a conspiracy, it's a mechanism. Fear accelerates it, but structure enables it. And here's the unsettling insight. Systems don't fail when everyone panics. They strain when enough participants calmly stop trusting the same reference points. Once confidence erodes quietly, coordination breaks. Everyone starts optimizing locally instead of collectively. That's when shortages appear in unexpected places, even without a headline crisis. This isn't about predicting collapse, it's about recognizing that the rules are bending. And when rules bend without being announced, the people relying on old assumptions are always the last to adapt. From here, the path forward splits, and neither option is clean. One path assumes pressure eases, refining backlogs clear. Supply chains adapt, prices cool without breaking confidence. That outcome depends on time, coordination, and patience. Three things markets rarely offer when fear is involved. The other path assumes momentum persists, demand stays elevated, access remains uneven, price becomes secondary to availability. In that scenario, behavior shifts again, people stop selling, institutions lock in supply earlier, volatility increases, not because of speculation, but because of scarcity. Neither path guarantees safety, both imply change. And the key detail is this: you won't get a clear signal telling you which path you're on. The transition reveals itself through small frictions, longer waits, wider spreads, conditional liquidity. Those are already visible. That's why the next move feels like it's forming off stage, not on the chart. The market isn't asking for belief, it's testing behavior. And once enough participants respond the same way, direction stops being a forecast and starts being momentum. The deepest insight here isn't about silver or gold. It's about trust. When prices rise but access tightens, when benchmarks fracture, and when institutions reposition without naming the risk, the story stops being about returns and starts being about confidence in the system itself. This entire sequence can be summed up simply. Markets don't warn you when rules change. They show you quietly through friction. What looks like a rally is also a test of patience, of assumptions, of how prepared people are to operate when the old signals stop aligning. And this isn't the end of the story. It's the opening chapter of a longer transition that hasn't been fully priced yet. Because if this pressure continues, the next phase won't be about how high prices go. It will be about who can still move and who can't. If you want to understand that phase as it unfolds, follow along. This story is just getting started.